Good afternoon, everybody, and welcome to Essentials. My name is Dale Franklin, and I'll be hosting you today. Today we'll be exploring the wonderful world of tech and about investing in the tech sector. David Gibb, who runs our technology fund, will be taking it through. David has the inevitable qualifications of both being a doctor and a CFA and a CA, so he clearly loves to study. So I'm sure he'll have some wonderful insights for us. If I could ask you to please enter your questions in the Q&A function at the bottom, and we'll handle as many as we can towards the end. This event, you will get CPDs. Please do ensure that you stay on for the entire event. If you leave halfway, we unfortunately will not be able to get you a CPD point. So with that, I'd like to please introduce David Gibb. Hello, David.
Thank you, Dale. Just to clarify, I'm not actually a fully qualified doctor. So I finished third year and then I decided there were other things to do. So
you'll always be Dr. Dave to me.
Exactly. Thank you, Dale. So anyway, thank you everyone for joining us. And I'm looking forward to talking to you about the tech sector. A sector that I've covered probably for, I think it's about 22, 23 years. So it's maybe just touch on what we're going to talk about today. So I just want to make it clear, firstly, is why the tech sector is unique, and it really is unique. And that's why it's typically performed so well over many decades. Then we'll talk about the current trends in tech. And there's some very exciting things going on. Obviously, there's always new stuff in tech. I mean, that's what technology is all about. If we'd been giving this talk hundreds of years ago, we would have been talking about maybe the new telescopes that had been designed. And then when to invest in the sector. So I'll give you some thoughts on that. And then we can take some Q&A. So let's just start off by looking at why the tech sector is unique, and really, I often refer to Brian Arthur, who for me is the person who understands tech probably the best. And you're welcome to look at some of his books. They're rather dry reading at times, or look at some of his YouTube videos too. So Brian Arthur, who's I think turning 78 this year and is an absolute master in the field. So if we just talk about new technologies are generally just combinations of technologies from the past. So what an inventor might do is say, look, let's think of the guy who came up with Uber. What you do is you've obviously there's a human need here for people to get around, not have to phone a taxi service, but to do it all on their cell phones. And so typically what the inventor is going to do, he will look in the Lego box of technologies that have come before, and he might often just be able to recombine some old technologies, and that will create something new. So technologies, you don't want to think of them, new technologies, as someone sitting in their attic and coming up with something completely on their own. It doesn't work like that. So we've had centuries of new technologies being released, and people will draw on the Lego box of old technologies. And typically for a novel new technology, for something really different, they will capture a natural phenomenon which hasn't yet been captured. So if it was understanding gravity, or some of the quantum nuclear work, that would have been one or two scientists who captured a particular phenomenon and then were able to recreate that in a particular technology. So that's for very novel technologies. But generally, technologies are just combinations of old technologies. So that's the first thing, the combinations idea. The second one is technology tends to come in clusters. So once you have one or two novel technologies in a new cluster, then lots of other inventions will follow. And so you'll have a wave of technology coming in a particular field. So if we start on the left with the optical cluster, it was right early in the 1600s when people were working with things, basically very primitive eyeglasses. And someone came up with something, a rudimentary telescope in the early 1600s. And then Galileo, who you've all heard of, who was interested in astronomy, he kind of made, he converted this basic telescope, into something a little bit more complex, right? And that allowed him to study the planets, to understand how they moved around the sun. He could see moons on different planets. So, and then what also happened was that microscopes were also developed at a similar time. In fact, telescopes and microscopes were first kind of identified in Holland. And that allowed people to see bacteria for the first time. They didn't really make much use of that, being able to see bacteria at first, and that came later. But what led from that was a wave of technologies in the optical cluster. So Isaac Newton then came up with a more advanced telescope later in the 1600s. And so what you saw then was a wave of innovations in this area gradually move across the world, and it influenced society and the economies. The next one was the chemical cluster in the 1700s. And once again, a lot of things evolved from that. People were able to isolate hydrogen, the process of making salt. And once again, there was a cluster that came through over the decades. The electrical cluster, I think by the 1840s, people had kind of captured this natural phenomenon of electricity. And then we saw the introduction of basic electric engines and electrical equipment. And that's something that has continued for decades since then. So that was another big cluster that developed, and partly related to that was, electronics, where a wave of new electronics started coming to market from about 1905, right up to the 1960s and a little bit later. And I'll show you a chart on that in a second. But now we're in the digital cluster, right? Digital technologies. And I suppose this probably started with the discovery of microchips, with the distinction between noughts and ones, and the wave of digital technologies since then, with software and all sorts of other things, which we will come back to, is still having a major impact on how we live. So this is just an example of that electronics cluster, and it just shows how electrical appliances were adopted across the US economy. So starting in, say, 1905-ish, or around that time, we had the, refrigerators became popular, vacuum cleaners, washing machines. And then I remember when I was little, the microwave arrived, and had a huge impact on number of people working in homes, how much work, your parents would have to do. So a big impact on how people lived. So I think the point to take away from this is that clusters work by sweeping across the economy. Corporates look at these different technologies, deciding what they're going to adopt. They might not adopt everything. It affects jobs. Some jobs are lost, other jobs are created. And so in that sense, it changes the economy, and it has big changes to society, right? So, here we're looking at e-commerce, which is really a part of the digital cluster, and what sort of changes that's having in the physical retail space. So I think what you should take away from just these few points from Brian Arthur's thoughts about technology is that it actually drives the economy. It's in the driver's seat, right? And you can see that now with the digital technologies that are coming through. they have a very strong impact on jobs, job losses, job creation. And we'll come back to this in a sec. So that's the first thing. The second thing I want to touch on when we talk about what makes technology unique, and this is Brian Arthur himself. He wrote a piece in the early 80s about rising returns in knowledge-based sectors. And he wrote this paper. He actually had it submitted. It was rejected, by the publishers on his first attempt. They thought it was, they thought it was not newsworthy and thought it was rubbish, I guess. So, but what his paper was about was that in the knowledge-based economies, what often happens, unlike the traditional economy where you may have manufacturing, where you have diminishing returns as you get bigger and bigger and bigger. And so typically, a manufacturing business can't have 100% market share. Typically, they're diminishing returns. You've got to build more and more plants. But what happens in the knowledge-based economies is you have rising returns. So once you spend a lot of money up front and you get everyone to buy into your product, say it's Microsoft, which was, the operating system for personal computers. People tend to lock in to a lot of these types of technologies, and you find that you develop a monopoly quite quickly. So, and what happens then is your marginal cost of producing, a new Microsoft software for the next computer is close to zero. So the economics of the traditional economy versus the knowledge-based economies are completely different. And in that sense, it makes it hugely profitable. And once you've locked in an area and everyone is now using Facebook or everyone is using Google, it becomes, look, you've obviously got to stay on your toes, but it becomes a little bit more difficult for new entrants to come in. They really have to disrupt you with something that is, that is possibly far superior to what you have or a lot cheaper. So this is the second point. And this talk about network effects is always the thing that people remember when you talk about technology. And that's why you almost want to invest in have quite a large share of your portfolio in tech shares because of the different economics. And then the last thing, which is partly related to rising returns, is the fact that financial statements for a tech company are not always that useful, right? So when you look at the balance sheet of an Apple or a Microsoft, there's actually not much on the balance sheet, right? There typically isn't that much in fixed investment, in plant, in machinery. What they've done in the beginning is they've spent a lot of money up front to gain users, and most of that goes through the income statement as R&D or sales and SG&A, so sales and admin kind of expenses. So what you find then is over the last few decades, financial reporting has become slightly, less and less useful in a way. So when I look at the balance sheet for Amazon or for Apple, it doesn't help me that much in trying to value the business, right? So this declining relevance in a way is associated with this big spend on R&D and SG&A as a percentage of sales. So we're talking about companies that have huge intangibles. They have a network which is not reflected on their balance sheet. They have millions of users. Their brand value is very strong. And in some ways, I think the accounting profession needs to catch up and make some changes for tech to be more relevant or for financial statements to be more relevant for the tech sector. So just summing up those points on what makes technology unique, this idea of technology clusters, the idea that technology actually drives the economy, right? And you can see that in the way you work, and tech is becoming certainly obviously it evolves, and we might start a new cluster in a different area, but it certainly drives the economy. The other thing is rising returns and network effects, different economics, very different to what you see in the banking sector or in consumer products, and the fact that a lot of these companies become monopolies. So a good place to invest. And then the last one, financial statements are not that helpful. So for me, I mean, those are the three that I came up with. I think those are the most obvious ones. And maybe you just want to remember that when you think about tech versus other sectors. So if we move on to the second thing, let's talk about current trends in tech. Now, you look on the internet and everyone has their trends for 2023. So what I did was I just looked at what came out of Davos earlier this year, the World Economic Forum, and what do they feel are the key trends for 2023, the technologies to watch, right? So if we start on the left, green tech at a tipping point. I mean, I'd go along with that. Last year, the US passed the Inflation Reduction Act, and there's 369 billion of subsidies and all sorts of other things to really push this conversion to a less carbon intensive economy. So absolutely, that's an important point. The second one, hyperconnectivity and cyber resilience. I suppose it's even more topical now with the Russian invasion of Ukraine. A lot more attacks from different parties here, and I guess the return to some kind of Cold War means that there are more attacks, arguably from east to west and in the opposite direction, I suppose. So it's a key factor, and cyber is just becoming a bigger and bigger issue as companies move more and more to the cloud, right? The next one, quantum computing R&D. Look, we're not ready yet for quantum computing to take over a lot of the functions from classical computing, which is the way my computer works. Quantum computing is still some way off from becoming commercialized, but the key is we're looking for signs of progress. And the big players here are IBM, Google, and there are quite a few other smaller players as well. And so we're waiting to see what comes out of this area. The next one is gene editing goes mainstream. And yeah, this is potentially a new technology cluster, the whole biotech area, all based on the Human Genome Project, where people were able to sequence DNA material. And now it can be done actually relatively cheaply for under $400 for a whole genome. So there are companies that are using CRISPR-Cas9, which is where they've captured a natural phenomenon, which is where bacteria defended themselves against viruses. And that's really the CRISPR-Cas9 process. And companies are testing this now, and maybe we will have some launches pretty soon. So a very exciting field, particularly for people with genetic diseases. And then the last one is AI. AI everywhere. This is obviously very topical at the moment with this chat GPT. So what I'm going to talk about here is just the first one, the green tech and AI. And you in your own time, just keep an eye out for these other three. So just a slide to show you, this is from the FT just a couple of days ago, what is expected to be spent on renewable energy in the US over the next 10 years, right? So the spend number is annual investment is that blue wavy line over here. And this is how the spend is likely to be split between the different areas. So you can see a massive growth in the pink box here, which is the solar rollout of solar. Storage has also got a lot of growth ahead of it. And then obviously we've got onshore wind and offshore wind. So expected gigawatt capacity increases moving from under 40 gigawatts all the way to 120 gigawatts over the next 10 years. So massive investment here, all based on Joe Biden's passage of the Inflation Reduction Act. And it's causing a lot of European businesses also to think of feeding into all these subsidies. Now, remember, at the moment, China is the leader in clean tech. They produce 2/3 of all the batteries that go into electric vehicles. They produce 3/4 of all the solar panels being manufactured that you might be installing on your roofs or have plans to do that. So the US is also trying to establish, to reinvigorate their own manufacturing capacity. We'll have to see if this works or how well it works. A lot of money will be wasted. In a way, it's a process of deglobalization. We're not picking the cheapest country to do it anymore, but the US wants to be more self-sufficient. They don't want to be reliant on all those solar panels and all those batteries coming from China. So a big trend. The key here, it's difficult, I've found, to invest in this, but we keep our eyes open. A lot of it is manufacturing related, but we keep our eyes open on this. And obviously, it's also going to start up new fields like carbon capture, like green hydrogen, and sort of bioenergy as well. So there will be new things that feed from this. And then the last of those 5 trends for this year, for me, is AI. And this is part of the digital technology cluster. And I just wanted to give a little bit of history here on how we've got to this point where AI is now so topical. So if you think how, if we go back a couple of decades to the 70s and 80s, the whole thing in tech was about integrated circuits. It was about CPUs, miniaturizing CPUs and memory semiconductors so that we could improve computation, right? So we didn't just want to rely on a few big mainframes out there, but to miniaturize things and allow computation on a grand scale. And that was achieved by companies like, obviously, Intel, combining with PC companies. And it really was the PC era. And it allowed all of us to start computation on a serious scale, right? And that was really what the tech, that was the height of tech in those sort of 2 decades. From that, the next thing was about digital networks, was about connecting different computers around the world. And it really allowed the birth of the internet. And when everything was connected, it made the world feel a lot smaller. And it was the time when Cisco briefly was the biggest company in the world. And when a company like Data was in its heyday, really as a system integrator. So this was the time for the internet, and in a way, the cloud got going as a result of this technology, the laying of fiber optic cables all around the world. Now, and this really is the view of Brian Arthur once again. He wrote a really lovely piece, and you might want to look it up for McKinsey's. This is going back to 2018. And it was just his take on where we are now and the consequences of what's happening now. So the big thing now, it's really about sensors that are prevalent all over the place. We're talking about the Internet of Things. We collect data on a grand scale. So whether it's monitoring the blood, your blood flow using a particular smart watch, tracking moisture levels, rainfall levels, tracking sensors in the streets in China and in London, where you have all these cameras, and then doing something with that data, establishing algorithms and trying to develop some sense of what the data is telling us. And really what this is doing, it's moving intelligence from within the human within the human brain to an external intelligence, in the sense that now we can have facial recognition technology, we can have voice recognition technology, we can have things like chat GPT, all sorts of which scours the internet and then comes back with an answer, based on what you asked. So this idea that intelligence now becomes external, for a person like Brian Arthur, the question is, how significant is this? And it's potentially enormously significant because it can have a big impact on jobs. Traditionally technology would change, some jobs would be lost, but then new jobs would be created. So the issue here is, does this have a really bigger impact, and in the sense that some jobs might not be replaced? And so this is why things like basic income grants or whatever become topical. So, and what we're seeing now is AI is effectively moving across the economy, as we spoke about earlier. Industries decide what they're going to adopt and what they won't adopt, but it will have an enormous impact on agriculture. We've already seen that, energy, healthcare, banking, across all the sectors, including the investment industry. And I think that what's topical right now is, will this chat GPT represent some kind of threat to Google? Now, chat GPT is a technology that's come from a business called OpenAI, where Elon Musk was a co-founder. It's got a lot of ex-Google people working there. And in fact, Google is the leader in AI. So they own businesses like DeepMind. They have a business called Google Brain, where they have 800 researchers working there. And this is why they've got such a big market share in the search industry. Whereas Bing, which is Microsoft's search engine, has a tiny market share. And Microsoft has partnered with OpenAI and will be rolling out a Bing AI sort of search product. So I think it's important for me, because I think Google is not necessarily the tightest run business. They do have their own AI product, which they are launching too. But, I think this ChatGPT has already picked up 100 million users, which is something that UBS wrote about the other day. And so we'll have to watch out, because Google has a lot of profits certainly their profits have taken off in the COVID period. And we'll have to see what happens to their market share in the search space. So I think it is a threat, and they just need to mitigate or limit that threat by launching their products a little bit more boldly. They're showing a little bit of too much indecision, I think, at a management level at Google. And you can see here, this is just a headline from one of the articles in the Wall Street Journal just a few days ago, with this, excitement about AI. There's huge pressure on, chief investment or information officers at companies to build more AI apps. And the Chinese are obviously very worried about this too, because they can't access all the fastest chips. So a big drive across industry now to make use of this AI technology. So before we move on to when to invest in tech, I just wanted to touch on a few things I thought you should keep at the back of your mind about, that are related to current trends in tech. Section 230 is this in the Communications, I think, Decency Act, which basically means that whatever is published on Google or Facebook is, you can't sue Google or Facebook based on the content that other people publish on their site. They're not a publisher effectively. So they have immunity to whatever is published on, or whatever is broadcast or sent on their systems. So that has been in the Supreme Court in the US in the last 2 weeks, and we're waiting for a judgment there. And it could look, we've got some very conservative judges there, so I'm not sure what to expect. Probably not much. But there is some pressure on the Section 232 to be upgraded for current day. I think the original act came from 1996, so there might be some changes there. Activists at Salesforce, in fact, their results came out last night. They've got a few people rattling the cage there on their board. Intel, there's a huge fight for relevance at Intel. It's got left behind, and TSMC is the leader in manufacturing the most advanced chips. Generally, what you'll see on this list, it's some stuff relates to regulation around big tech. Other stuff relates to the semiconductor space, and then there are a couple of other things, the battles between the big tech players. But keep an eye on some of these. I won't go through them in any further. So I think if we move on to the third topic, which is when to invest in the sector. Now, I mean, let's come out up front and say what those conditions would be. I guess the first thing is you'd want sentiment to be very poor, right? And that's, because typically the sector always seems very expensive when you certainly look at it on a P basis or whatever. So it's always handy to invest when the sentiment is poor. The other thing is to invest when interest rates maybe are high and are due to come down in the short term. That would be a big plus, which is the opposite in a way in the financial industry, in the banking industry, where you want interest rates to go up, right? So interest rates high and coming down. And then the third key for me would be where the earnings outlook is positive, where we're not going into a downturn and where, we're likely to see upgrades to earnings. So I think if you look at all those three, I'd say the last one, I'm not sure where we are at this stage, right? Where we are looking for the economy to turn over slightly. So that puts a question mark on this sector and frankly on a whole lot of other sectors, but particularly this sector in the sense that often we look for a lot of growth from tech. So we need to look for resilient companies if we're going to buy into an earnings story in tech. So the first one, I think sentiment was not very hard last year. It was a horrible year. I mean, this slide just shows you what happened to the market cap of the FANGs. So Meta, Apple, Amazon, Netflix, and Alphabet, they lost $3 trillion last year. NASDAQ was down 33% last year. So the worst performance in 2008. And sentiment-wise, you needed to take advantage of that, right? So there was a lot of fear. Some companies that are arguably quite resilient were not very hard. So last year was a time to add to tech shares. There's absolutely no question. As uncomfortable as it felt, particularly in the last sort of 3 or 4 months of the year. So sentiment, it has improved a little bit this year, certainly in January. I think there was a lot of tax loss selling in December. Eventually people thought, well, let's just take advantage of these losses. And obviously quite a lot of fear. So then when you get to January, often we have the January effect and people are feeling more bullish about the year. And I think also some of the economic data that came out indicated that maybe inflation was not that bad and that we might solve that problem quite quickly. So there was a rush back into tech and there was quite a lot of short covering as well. Tesla, I think the hedge funds made the most money out of Tesla last year, followed by Amazon. So we've had a big run up in Tesla this year, up, I think over 60%. So, but it's lost a little bit of steam, this rally in February. Now people are getting a little bit more worried about inflation again. But I think generally sentiment it's not completely depressed right now, but it's not great still in the tech sector. And in some ways that's a plus. That's a plus if you are a tech investor. Sentiment is not running away, particularly in places like China, where arguably those shares offer potentially the most value out of all the tech jurisdictions. And so what has happened as a result of that is the P's on tech shares have contracted. This is just a chart showing the historic PE on the MSCI Information Tech Index and versus the MSCI World and S&P 500. All these PEs are down, which is great. In that sense, you want to be looking at this a little bit more closely now because the P's have come down. So, but I think, the next thing we want to just look at, as opposed to sentiment, is let's now talk about interest rates and inflation, right? So remember I said the best time, one of the best conditions to have is when interest rates are high and they're likely to come down. So this is where we are now. We have, last night, the US 10-year hit 4%, hit a 4% yield. And I think, it peaked in October last year at about 4.2, which was the highest 10-year yield we'd had, I think, in 14 years. So we're not really used to rates like this, certainly in quite a while. If you invert this and you say, well, what is a PE on a 10-year bond? Well, it's about 25 times. So whereas when the yield was 2%, the PE was 50 times. And when you compare that PE, I'm ignoring tax here, so I'm cheating a little bit. You compare a PE on the bond market of, say, 25 times with the historic PE on the MSCI IT index about 22.5 times, you'd say, well, look, I'd rather invest in equities here as long as I'm going to get some earnings growth. It's not as clear cut a case as it was when yields on bonds were at 2%. So you need some earnings growth, and then you will invest in equities ahead of bonds. But the point to take here is on a PE basis, there is more competition now from the bond market. So it's important that you get some earnings resilience, some surety in the earnings you're buying into in your tech companies. Now, staying on the topic of interest rates and inflation, I just want to touch on this area of the sensitivity of tech shares to interest rates and growth. So obviously when this is a sine curve for just showing the growth of businesses, right? I'm referring specifically to the tech sector. On the left-hand margin here, we've got the high growth companies, typically loss-making. When you do a valuation of these companies, all the value sits, later in there, maybe 10 years from now. So they're quite very sensitive to your growth projections and to changes in interest rates, but particularly sensitive to changes in growth projections. Then you move up the curve here, the business obviously becomes more profitable. Growth is still high, but it's slowing down now. So it's more about monetizing the profits. You can have a PE here on a business here. There are no PEs in these high growth areas. And then as you get to maturity, the PE typically drops, and interest rates have a lot less impact on the valuation of the. When interest rates go up, when inflation is going up, the pain really happens here in the high growth companies. So this is where you're going to see last year, a lot of the high growth companies were down 50, 60, 70, some down 80%. As you went up the curve here, these businesses were also hit hard, but not nearly as hard as the early growth companies. So in some ways, some of the areas to hide were in the lower PE, more mature companies. I'm not going to go into any detail here, but this just compares how sensitive the tech sector is relative to other sectors, like telecom services. So in a telecom business like Verizon, based on my discounted cash flow, roughly 2% 2/3 of the value sits in the terminal value, which is 11 years and beyond. Whereas in a business like Snowflake, right, you've heard of Snowflake, possibly it's a big data sort of AI related business. Almost 90% of the value sits in the terminal value. So when interest rates go up and people, become more short term in their thinking and worry about the growth rates, Snowflake's growing often at 100% per annum, their revenues, then you start pulling back all those projections and the share prices of these sort of companies just come plummeting down. Whether the earnings will plummet is another question. So you want to pick the most resilient of these. So where does the 10-year go? Because this is the second important consideration, right? We've spoken about sentiment. We're talking now about interest rates. And really, it's dependent on how sticky US inflation is. We were used to, for years, inflation running at 2%. And now it's, it's over 5, over 6%. And the question, how quickly does that come down? The market initially, recently was thinking it would come down quite quickly. But I think generally the market still assumes that inflation will start coming down quite sharply this year. We will have to wait and see. So there are doubts out there, which is great, because it means one of the reasons why tech is going through a little weak patch again in the last few weeks. So potentially, if this does come under control and the Fed lowers, the Fed funds rate, it could give another boost to the tech sector. Either way, it's creating certainly some uncertainty out there. And then the last thing I want to just touch on in this area is when to invest in tech is about earnings, right? So we've spoken about sentiment, we've spoken about interest rates and growth, or basically interest rates and the discount rate. And now the last thing is about earnings. Now, this is just a slide from Morgan Stanley talking about the business cycle. You can see a little red dot there on the end, and the sense that we are going into a downturn. So what interests me is it's a very small dot, right? So you would think that would become a little bit bigger if this is a genuine downturn. I mean, there is a sense out there that we're not going into a big downturn. We don't have big structural problems in the economy like we may have had in 2008 with the housing bubble. So there is a sense that this will be a mild recession, and that would be great. We'll have to see. Obviously we've got a war going on. We've got the sticky inflation. So that is slowing down the economy. So initial signs here are good. And you can see this in the earnings expectations for the S&P 500. We had earnings down about 4% in this last quarter, if you exclude energy. And we're looking for this next quarter to be the worst of the quarters, right? So it'll be down 10% in the March quarter. And then the feelings then that earnings sequentially will start moving up again. We'll have to see. It's maybe too early to say. But in this sense, it doesn't look too bad from a cycle point of view. So then how do you invest in that if we're talking about the tech sector? Obviously, if we're in a downturn still, we want to look at earnings resilience. And these are, the tech sector is now an enormous category. We've got hardware, semis, internet services. There are a lot of things to choose from. And they all respond differently in different times in the economy, in the economic cycle. Some are more resilient than others. And others, you want to wait for for a swing in the economy before you invest. So we've at Anchor, we're working on a tech cheat sheet, and I've got it in the background, work in progress. So please don't go and pour a whole lot of money in based on this cheat sheet. But the idea is here, if you're trying to invest around the business cycle, And what we're saying here is when the PMI, or purchases managers index, is above 50, the economy is expanding. And when it goes below 50, the economic conditions are worsening. So if you say at the moment, I think the latest reading is about 47.8. So the economy is weakening, and that's consistent with that Morgan Stanley red dot that I spoke about just now. Is, which areas should which areas will outperform under these conditions? And at the moment, it's probably things like PC games, which is very counter-cyclical. I mean, mobile gaming is a lot more cyclical, but certainly PC gaming is, and this would have been an area to have invested in several months ago and to reap those benefits now. The semiconductor space is another, it's an interesting one because it starts performing well when inventories in the channel peak. And that, I think, it's sort of happening now. And these shares have done very well the last few months. So companies like NVIDIA, TSMC, and ASML, we also bought into this by buying some more, some TSMC in October of last year. So, and now the question is, obviously, how long is this downturn going to be? But then we now need to start thinking about when we invest for the upcycle. We move away from the more defensive companies to the ones that will be beneficiaries of an upswing. And certainly biotech is one of those. So we have been buying more biotech recently. So buying into that gene editing theme, we've had a business, we've invested for quite a long time in teletherapeutics. So that's one we've been adding to. Also some drug discovery using AI. A couple of businesses there, Accenture is one of those. And then the area to watch out for these other three areas. Now, I just want to point out, this is a work in progress. We might want to shift some of these categories around, but we will come back to this in future talks with clients. But I think if we wrap this up, I want you to walk away with some important things. When we're looking at a particular tech investment, we want a visionary in charge, right? You need to be aggressive upfront in establishing a new market, establishing network effects. So you need to be bold and basically decide where you're going to take a new technology. You want to pick an area with big market potential. So, whether that was search or whether it was social media like Facebook or Tesla, in the EV space. And then it's important that you have some network effects, right? Because you want to establish market dominance. And where those economics are very different to the traditional economy. So that doesn't necessarily apply in the traditional Tesla business, but in that software business of theirs, maybe there you will get some important network effects. You obviously want to have good upside to a discounted cash flow, and the PE must make sense. Now, obviously, in those early years, there's no E, right? So you work out what blue sky earnings could be. What sort of margin could this business generate in 5 to 10 years? And that PE based on that blue sky earnings must make sense. And this is really what we're looking for. And if possible, invest for secular growth, right? You might want to own this company for many, many years. There are going to be a lot of business cycles around that. And some people might want to trade tactically within a year. But I think it's important that you always have a rough idea of what the tech investment is worth. So, this last 15 months has been very tricky for very high growth investors. If you owned all these companies in the middle of 2021, Tesla and lots of others, without having a sense of what they were worth, your clients were in for a very rough ride over the next 15 months. So obviously you want to invest for the long term, but always, if the valuation becomes absolutely crazy, then, you might need to think of taking some profits there. What is the outlook? This is, what is the outlook for the next 10 years? Well, certainly the last 10 years have been great for tech investors. If inflation is sticky, well, we could be in still for a slightly rough patch, right? But if your companies that you're looking at are resilient on the earnings front, and you're patient for waiting to make investments in the internet, software, and the biotech categories, there's a wide enough spectrum here to generate similar kind of returns over the next 10 years. So over multiple decades, the tech sector is the place to be. It's higher growth. It has the right sort of economics. And if you take advantage of poor sentiment, changes in interest rates, and being, I think, patient in which companies are going to show the most resilient earnings, you will do very well in the space. Just my last slide, just to say where we are. This is as of yesterday, how companies have been doing, some of the biggest tech companies out there. You can see over 12 months, all the tech companies are down, which is great if you're interested in the sector. I think Apple and Microsoft has shown their resilience, monopolizing the PC, smartphone industries. Obviously, big interest in the cloud for Microsoft too. Amazon looks probably the most geared to a recovery in the economy, big fixed cost base, and their e-commerce really has had this indigestion after COVID. So potentially a strong cyclical recovery when that cycle does turn. And I think for the first time in a long time, the tech shares in China have done over 12 months similarly to the rest of the US. And Tencent, hallelujah, is the best performer over the last 12 months. So that's certainly come through for Naspers. And frankly, in our view, we still think that there is a better chance. The short-term outlook in the Chinese economy is much better than what we're looking for in the US. So the Chinese shares look pretty decent value, I would say. So I think on that note, I think I've used up my time, and we can turn to Q&A.
Thank you, Dave. That was fascinating as always. If everyone can start putting their questions in Q&A, and we'll try to cover as many as we can. Dave, first question for you. Are we not currently also seeing biotech and nanotech engineering underway in this digital era?
I think we are. I mean, you could argue that it's a separate cluster. It's reliant on some different inventions, like the Cas. The CRISPR-Cas9 is based on capturing this phenomenon that the bacteria use to protect themselves against viruses. But there's no question we are in the earlier stages of something interesting there. And we've been looking at this field of synthetic biology for some time now, where basically you adapt, you make changes to bacterial cells or fungal cells, and you use these things to produce synthetic products. Like instead of, for a cosmetics company, instead of, to generate the peach aroma, you use synthetic biology to do this. So instead of extracting from the planet, we now use synthetic biology to do so. I think, arguably, and some people like Walter Isaacson, who wrote that wonderful book on the whole CRISPR-Cas9 story, this could be the century for biotech and for using, I suppose, DNA and genetic modification to to alleviate the pressure we have put on the planet. So I'm not sure. I gave a bit of a long answer. I'm not sure if I answered that question properly.
No, I think you covered it well. Dave, next question. To a large extent, we are investing in non-tangible assets in the tech sector, i.e. software, firmware, etc. Is that kind of investment deemed not rather risky?
Yeah, I think it's more difficult to value these things. There's no question. I mean, when I look at valuing JP Morgan, they have a book value. They've got a tangible book value, and I know that their return on tangible book, I think at the moment, is 18%. And I can work out what I think the business is worth based on the balance sheet and what return they generate on that via the income statement. So there's a strong link between the income statement and the balance sheet. The problem in software and most of tech is the balance sheet is sort of meaningless. So you're putting a lot of pressure on your income statement to come up with a value, and you don't have this double checking when you relate it to the balance sheet. So it definitely makes it more difficult, and that's why I think you need to take advantage of pressure situations like we've had in the last last year, and we might have a little bit more. You never know. So try and take advantage. You tend to have, when there's fear in tech, I think it can be a lot worse than fear in other sectors, right? Because shares drop like a stone.
Thank you, Dave. How far in the future do you look when assessing market potential of a tech company?
Well, we try and do, in our tech team, we try and we do a discounted cash flow, right? So, I mean, I'm looking at 10 years where I look at the margin, the revenue growth, whatever, over 10 years, specific 10-year period, and then we'll establish a terminal value after that. You have to do that because most of these companies, I mean, you think of something like Atlassian, which is a very interesting software company. They're not making any profits now. I mean, they may be if you ignore stock-based compensation, which is cheating in a way. But if you include stock-based comp, most of those mid-cap software as a service companies are far from making a profit. But you've got to assume that in 5-6 years' time, they've got they generate all this subscription income. They've got these customers, right? And they're quite loyal customers. You would think that, they will establish an operating margin on a GAAP basis, maybe in 5-6 years' time. So you need to look out quite far. Otherwise, your valuation, if it's based on current fundamentals, it really is, it's a shot in the dark.
I have one that you should be very qualified to answer. It seems that Naspers and Prosus are currently yo-yoing wildly. Any reason?
Well, if I think of Tencent, for example, Tencent got down to, it was just under 200 Hong Kong dollars in the second half of last year, and then it almost doubled up to 400 Hong Kong dollars. Now I think it's back at 363. So we've had a massive recovery in tech in China. The same applies to Alibaba. I think it got down to the high 50s, and then it went over 100. Now I think it's about 90 US dollars on the US market. So that's still a big recovery. That's a 50% recovery from its lows. And so I think we've had this massive flow into Chinese equities, but now we need the earnings to come through. So the economy should expand this year, and the projections are pretty good, especially for retail sales in China. So I think we should follow through now with earnings to justify the movements in these share prices. And basically that can feed through to Naspers and Prosus.
Dave, do you see the discount narrowing any further to NAV?
So I'm no expert to talk on that. You'd have to, I'm sure Mike Christie will be comment. I haven't been monitoring that closely recently.
If PE is not a reliable indicator to use, how should you evaluate the high tech growth stocks or compare stocks within the tech?
So I think it's important to know what the market cap is and always bear that in mind. If it's a new tech category and you've got a market leader and the market cap is $1 billion. I mean, I think back when I invested in Intellia Therapeutics, I mean, it's biotech, so there's technology involved. The market cap was $600 million. It was doing the most interesting things in the space. There were no earnings, there were no revenues. But the market cap felt okay. It's small enough. And and then the share price obviously went up 10 times after that. So it's a question of what could they do in a perfect world? What could the operating margin be in years to come? And so then you use a sort of blue sky earnings. And what would that be? I mean, I think a PE on something like a Spotify at the moment on blue sky earnings is about 19 times. That's not bad for a company that's growing at 15% per annum.
Dave, an easy one for you. Is there any protection in the fund to mitigate rand depreciation?
Well, you mean rand strengthening. So, yeah,
I would assume the question is depreciation. So I assume.
Yeah. So I think, look, if we're talking, and I haven't spoken product specifically here. So we run the Anchor Global Tech Fund. We haven't done any hedging for a while in that fund. So if the rand appreciates, you feel all the benefits in that fund. Most of the, we have a weighting and nice person process, but 80% of the fund. More than 80% of the fund is invested around the world. So if the rand weakens as it has this year, you feel full benefit of that. There are times when we consider hedging. In other words, so if the rand is going to strengthen, we try and lock in the current value of the rand. But we're not doing that at the moment in the tech fund.
So Dave, we are at time, so I'm going to do one last question. You alluded to being exposed to China, who have proven to be rather volatile. Is this increasing the risk a lot?
I think it does. It does increase the risk. I mean, we've obviously had this political turmoil there and the problems with the COVID shutdowns. We've also had this election of Xi Jinping for his third term, and that's going to be ratified now, I think, in March. I think it's in March. So a lot of that will then be behind us. I mean, obviously, the relationship between China and the US has deteriorated a lot. And this war in Ukraine hasn't helped, with China siding with Russia. Look, I don't think China is completely uninvestable yet. It has a big local economy. I think the Chinese companies will struggle to grow outside of China. So you want to be reliant on the Chinese firms growing within their own country. So we have a high discount rate. When it comes back, we talk about discounted cash. We do use a high discount rate for China. And so you need more upside before you invest in China.
Thank you, Dave. We really appreciate your time. I'm sorry we couldn't cover all the questions today, but we look forward to seeing you next time at Essentials. Thank you, everybody, and goodbye.